Welcome to our new episode for today. Billionaire investor Ray Dalio, founder of the world's largest hedge fund, has been in the game for over 50 years now. He recently shared some valuable insights that we need to talk about, and he's seeing a shift in the stock market and economy that's going to change the investing landscape, and we're going to break it all down for you here in 3 simple questions. First off, what exactly is Ray Dalio seeing? Secondly, why are these changes happening? And lastly, how can you take advantage of this opportunity and not miss out? But hold up, before we get into all of that, do me a favor and smash that like button and hit subscribe because my goal is to bring you investment ideas only from the very best. Alright, now let's get cracking. During a recent interview with CNBC in February of 2023, Ray Dalio described the current economic environment as in the 12th and a half economic cycle since 1945, which he considers to begin a new world economic order. He explained that typically these cycles involve economic weakness, stimulus, debt, inflation, and monetary tightening. According to Dalio, the year 2020 saw a confluence of factors, including the COVID-19 pandemic and a change in the distribution of wealth, which resulted in the government distributing stimulus checks to citizens. This injection of funding led to a surplus of money in the system, causing an imbalance. Inflation rates began to rise and debt increased throughout 2022. As a consequence, with the current higher interest rates, cash is becoming a more appealing option. The economy is experiencing significant changes as a result of these events, and investors need to be aware of the implications of this situation. As a result, it is critical to understand how these shifts in economic trends may impact investment strategies. Previously, cash used to be trashy, as it had negative real rates, says Dalio. But now, with real interest rates going from minus 175 basis points to plus 175 basis points, cash has become relatively attractive. It's not only appealing in relation to bonds, but also to stocks. As rates go up and money becomes tight, cash emerges as an increasingly viable option for investors. Now, over the past 30 years, investing has been characterized by lowering interest rates, which has created a unique investment environment. However, this situation has started to change dramatically in recent months. The United States Federal Reserve has been increasing interest rates at an unprecedented pace, bringing the federal funds rate up from 5% to 5.25% as of the creation of this video. This shift from 0% interest rates to a more normalized rate environment may seem insignificant to the average investor, but it fundamentally alters the investing landscape. The annual percentage yield on my high-yield savings account in 2021 was a mind-boggling 0.4%. Even assuming a normalized inflation rate of 2%, having such a low interest rate on a high-yield savings account means when I kept my money inside account, I was essentially wasting money. I needed to account for the impact of inflation when calculating my real return. And as a result, Ray Dalio declared that cash is trash just a few years ago. Now, by holding large amounts of cash, you were essentially penalized because inflation far exceeded the minimal return that you could generate. However, the recent rise in interest rates has changed things so that you can now earn 4 to 5% just by holding cash or cash-like assets such as a short-term US Treasury bond. So if we return to a real return equation and increase the return to 5% while keeping inflation at 2%, we can see that our real return is now 3%, assuming inflation returns to more normal levels. This is the first time in many of the people watching this video's investing lives that the real return from holding cash is actually positive. So for the first time in nearly a generation, investors can actually generate a return on cash and cash equivalents. This shift in the interest rate environment is the result of the Federal Reserve raising the benchmark interest rate from 0% to a more normalized level. And when interest rates rise, the way investors can approach investing changes fundamentally. Just imagine yourself as a pension fund manager. Your job is to earn an 8% annual return of the fund you are managing in order to meet current and future obligations to retirees. This 8% return target is required to ensure that the pension fund does not run out of money, so monthly checks can be sent to the retirees to cover their living costs. Let's assume you have 4 typical asset classes to invest in. You have cash, bonds, stocks, and alternative assets. On one end of the spectrum, you have cash, which carries the least amount of risk but also has the lowest expected return. On the other end, you have alternative assets, which include private equity, hedge funds, venture capital, real estate, and so forth. These are considered the most risky investments, but they also have the highest expected return. Now, as the investment manager, your job is to achieve an 8% return while taking as little risk as possible. So if you were to invest in 2021 when interest rates were almost at zero, the 4 categories of your investment universe might have looked a little like this. Cash has a 0% expected return, bonds are expected to have a 2% return, stocks are expected to return 7.5% per year, and the expected return for alternative assets is around 12% per year. So if you, the fund manager, had simply distributed the pension fund's money evenly among the 4 categories, so that 25% of it was invested in each category, the overall return would have only been 5.4%, falling quite short of your 8% objective. But what can you do in this case? Well, if you want the fund to meet its obligations down the road and to keep your job, you are forced to go out on the risk curve. In technical terms, you have no choice but to allocate more money into more risky assets in search for additional yield. This is a dilemma many money managers faced in the last 10 years when interest rates were kept near zero or even negative by certain central banks. This means, for example, that you, as the fund manager, would reduce the amount of cash or bond in the portfolio and then invest that money in riskier assets such as stocks and alternatives. Now, stocks and alternative assets each account for 40% of the portfolio. Bonds and cash at a mere 20% of said portfolio. The good news is that the pension fund is now meeting its 8% return target. And the bad news is that 80% of the pension fund's assets are now invested in stocks and alternatives as opposed to just 50% previously. This makes a pension fund vulnerable if there is a prolonged downturn in the stock market and economy. It also makes the fund's return quite volatile, something not desired by the nature of said fund. Now fast forward to today's environment. With the Fed raising the Fed fund rate from 5% to 5.25% at the time of this video, it essentially makes cash-like investments attractive again. Assets such as short-term T-bills and money market funds are now yielding a generous return for investors. Better yet, these securities are considered super safe. And now, as a pension fund manager, you may have these expected returns for your investment universe. Cash at 4%, bonds at 6.5%, stocks at 7.5%, and alternative assets at 12%. You can now reduce allocation to stocks and alternative assets to 30% each and keep 20% of your money in cash and bond positions each. Overall, you have 40% of your portfolio in less risky categories, and you still meet your 8% return target. Warren Buffett, the greatest investor of all time, has over $100 billion in cash, indicating that holding cash is not always a bad investment decision. However, when the facts change, so should your investment strategy. As Ray Dalio observed, rising interest rates create a new investing environment that investors should adapt to. And one way to take advantage of this shift is to invest in short-term US Treasury bonds, which are backed by the government and offer higher yields than typical high-yield savings accounts. Another option for parking cash is to consider money market funds, which are fixed-income mutual funds that invest in debt securities with short maturities and low credit risk. These funds offer excellent liquidity and very low volatility, making them an attractive option for risk-averse investors. At the time of this video, many money market funds have had a yield well above 4%. Investors need to consider the changes in the investing landscape and adjust their investment strategies accordingly. Holding cash is not always a bad investment decision, and in certain situations, it can actually be a wise choice. However, with interest rates on the rise, investors should explore alternative investment options to generate returns and protect their portfolios from inflation. And that is it. Thanks for watching our video for today. We hope you found Ray Dalio's insights on the current shift in the stock market and economy valuable. As we discussed, this change will fundamentally alter the investing landscape, and we've broken it down into 3 simple questions for you. What exactly is Ray Dalio seeing? Why are these changes happening? And lastly, how can you take advantage of this opportunity and not miss out? But before we go any further, if you enjoyed this video and learned something new, please hit that like button and subscribe to our channel. Our aim is to help you become an awesome investor by learning only from the very best. We hope you find this video helpful and informative, and thanks again for watching. We'll see you in the next one.